Hi everyone, welcome back to Bullion Point Podcast, where we simplify the world of precious metals and help investors make more informed decisions. Hi, I'm Jia Xuan, and I'm your host for today's podcast. Over the past two episodes, we've covered the fundamentals of precious metals investing and explored the differences between investing in physical bullion, paper assets such as ETFs, and stocks. Today, we're taking the next step by looking at something that many new traders are curious about: how experienced traders analyze the market before making investment decisions. Joining us today is Mr. Bhavesh Lankapati, Director of Bullion Point and an experienced precious metals trader. In this episode, he'll be sharing the disciplines, thought process, and analytic approaches that have helped him navigate the bullion market over the years. He'll also introduce some of the commonly used market indicators and financial data that traders observe when analyzing gold and silver prices. Whether you're just starting your precious metals investment journey or looking to better understand how experienced traders approach the market, this episode is for you. With that, I'll hand it over to Mr. Bhavesh.
Hello, everyone, and welcome back to Bullion Point Podcast. I'm Bhavesh Lankapati, Director of Bullion Point. If you have been following our series, we have already covered the fundamentals of precious metal investing and discussed the differences between physical bullion and paper investments. Today, I'd like to take things one step further by talking about a question I often hear from new traders: how do experienced gold traders analyze the market? Many beginners think successful trading is about predicting where prices will go tomorrow. In reality, it's much more about developing the right discipline, understanding the data available, and making informed decisions rather than emotional ones. In this episode, I'll share some of the technical tools that traders commonly use, along with the habits and mindset that can help you become a better precious metal trader. Let's begin. One of the biggest misconceptions among new traders is that there is a secret indicator that tells you exactly when to buy and when to sell. The truth is, there isn't. Professional traders don't rely on just one chart or one number. Instead, they look at multiple indicators together to understand what the market is telling them. Think of it like visiting a doctor. A doctor doesn't diagnose a patient using only their temperature. They'll also look at blood pressure, heart rate, medical history, and other test results before making any conclusion. Trading is very similar. Every tool gives you another piece of the puzzle. The first and most basic tool is the price chart. Whether you are trading gold or silver, your chart tells you how prices have moved over different periods of time. You can look at daily chart, weekly charts, monthly charts, or even shorter time frames if you are an active trader. One of the first skills every trader should learn is identifying trends. Ask yourself, is the market moving upward? Is it moving downward? Or is it simply moving sideways? Trying to trade against the overall trend is one of the most common mistakes beginners make. The next concept is support and resistance. Support is a price level where buyers have historically entered the market. Resistance is a level where sellers have traded to take profits. These aren't exact prices. They are more like areas where market participants have previously shown interests. Understanding these zones can help traders identify potential buying opportunities or areas where prices may struggle to move higher. Again, these aren't guarantees. They are simply probabilities based on historical market behavior. Another commonly used tool is the moving average. A moving average smooths out short term price fluctuations so traders can better identify overall trend. For example, many traders observe the 50-day moving average, 100-day moving average, or even the 200-day moving average. When prices consistently stay above a long term moving average, it often suggests that the market remains in an overall uptrend. When prices remain below it, traders may interpret that as a weaker market. It's a simple tool, but it's widely used because it helps reduce market noise. Gold doesn't move in isolation. One important market to watch is the US dollar. Since gold is internationally priced in US dollars, there's often an inverse relationship between the two. When the US dollar strengthens significantly, gold prices may face downward pressure. When the US dollar weakens, gold often becomes more attractive to international investors. Notice I said often, markets don't always follow the same pattern every day, but understanding these relationships gives traders valuable context. Another important area to monitor is the broader economy. Two statistics that many traders follow are interest rates and inflation. When inflation rises, investors often become more interested in assets that may help preserve purchasing power. Interest rates also influence gold prices because they affect the attractiveness of other investments. This is why experienced traders pay attention to economic calendars and major central bank announcements. You don't need to become an economist, but understanding these key economic drivers will help you better understand why prices move. Numbers tell one story, people tell another. Experienced traders also observe market sentiment. Are investors becoming fearful? Are they becoming overly optimistic? Major geopolitical events, financial uncertainty, and global economic news can all influence precious metal demand. This doesn't mean reacting emotionally to every headline. Instead, it's about understanding the broader environment in which prices are moving. Now, I would like to share something that I believe is more important than technical indicators: discipline. I've met traders who know every chart pattern imaginable, but they still lose money because they lack discipline. Successful trading isn't about being right all the time. It's about following a consistent process. That means having a trading plan, knowing your entry and exit strategy, managing your risks, avoiding emotional decisions, and continuously learning from both your successes and your mistakes. Technical analysis is only useful when combined with discipline. One mistake I encourage every beginner to avoid is relying on a single indicator. Markets are influenced by countless of factors. No chart, formula, or software can predict the future with certainty. Instead of relying on instinct or emotion alone, having a structured approach to analyzing the market can help improve the quality and consistency of your decisions. The more information you consider, the better your understanding of market conditions may become. While no method can guarantee the outcome of a trade, combining different sources of information can help increase your confidence and improve the accuracy of your market analysis over time. Ultimately, successful trading is about making informed decisions based on probabilities, not certainties. That's an important mindset for every trader to develop. As we wrap up today's episode, I'd like to leave you with one final thought. Learning precious metals trading is a journey, so don't rush to master every indicator overnight. Start with the basics. Understand price trends, learn support and resistance, become familiar with moving averages, pay attention to important economic indicators, and most importantly, develop patience and discipline. These habits will serve you far better than chasing the latest trading strategies you see online. Thank you for joining me for today's episode. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more educational content from Bullion Point. If there are any trading topics you'd like us to cover in the future episodes, leave them in the comments below. I'm Bhavesh Lankapati and thank you for watching. I'll see you in the next episode.